historically did not try and prescribe levels of investment itself. What the committee decided on was an intrinsic value and implicitly, to some extent, a range of intrinsic values that would reflect the uncertainty. When you do that, you do get sort of the wisdom of crowds effect. If you just have everybody vote on an allocation and average the allocations, you do not. That is a very clever way to aggregate this information. Now, the bald guy with the tie, you're not part of this class, right?
He's my colleague.
Oh, he's over 2.
The first thing I'm going to do when I get home is tell my wife you called me bald now.
Listen, that's the best I can do under the circumstances. All right. So really what you should take away from that is that in large organizations, aggregation of information is something you have to think about. Now, tonight's speaker, I have to make one announcement before. The winners of the Sonkin Prize are, and I think I forgot to bring a piece of paper, but I know who you are. It's David Adamsey. Are you here? Typical. This is one problem that I have. They write questions, they do work, and then they don't show up. Sorry? Okay, so he did, Roland, he got the 2,000 of the 2,500 prize. Is Laurence here? Laurent? We get a short on Blue Nile.
Yep, here.
Oh, there you go.
Yeah.
Oh, okay.
Yeah, there.
You get 500 for the second place vote. All right, listen, you're going to have to sit down someplace. I'm sorry about this. It's got to be somebody here who does it. Anyway, tonight's speaker, because it is in fact the last speaker here, I'm going to both tell you what he does and I'm going to do the summary ahead of time and then you can listen to him. And then I'm going to just do a little boasting on my own behalf because he really needs no introduction, which he objects to, by the way. But there's no way I can be stopped once I'm up here. So, first of all, that as you listen to these speakers, one obvious dimension in which they differ is their attitude towards risk. Somebody like Glenn Greenberg or somebody like Li Lu are prepared to take, in the short run certainly, risks, and short-run risks are the ones that you can really control, that are fairly substantial. They run concentrated portfolios. They think they're going to do very well in the long run, and they are diversified to some degree, and you get a lot of diversification at 10 to 15 names. That is a lot of the potential diversification. But I think realistically, as you think back over these speakers, there are ones who are interested in bargains that are going to do well in the long run and really are prepared to focus on the upside, and there are people who are concerned with risk. What you're going to see tonight is the extreme risk-averse end of the spectrum. That when Seth invests, I think it's fair to say his primary concern is not how good this investment could be. Although he's willing to make small investments with very substantial upsides if the upsides justify the potential of the loss. What he is concerned with is protecting against the downside, even though he has had, I think, 2 down years, which are not down by much. I think it's fair to say of those years that they did not occur because there was any permanent impairment of capital, and they are subsequently reversed. Now, it's very different from what Andy Weiss does, where really his risk management is almost a byproduct of the particular approach that he takes and the things that he looks at that he's good at. In Seth's case, it is literally starting with the principle of preservation of capital and then trying to do as well as you can with that constraint. So when you look at his returns, and I think they're now after fees 20% roughly, 19 to 20%, that return should be judged not against some other returns that may be slightly higher, but adjusted for the risk profile that has delivered those returns. The style may not be for anyone, but I think it's fair to say of all the investors you've seen, the one with the longest, most successful risk-adjusted profile is Seth. The boasting is that I knew that when he was an MBA student at Harvard Business School. Seth.
So, thank you, Bruce. Thanks for cutting that part of the introduction short. Jim will always be that bald guy with a tie now in our office. Maybe even at home. So it's a treat to be back here at Columbia. I know that I'm the last of many speakers and many classes. I thought what I would do, I'll try to leave plenty of time for questions at the end. If you want to interrupt me without interrupting the flow too much, feel free to do that as well. I'm going to talk a little bit about how our firm got started, what our philosophy was at the beginning, how it has evolved, not very much to this day, although how we practice it has evolved based on market opportunity, and a little bit about what we're doing. The firm came together as I was graduating business school in 1982. I ran into some well-to-do people, some on the faculty at business school. This is a well-known Boston business school, and it was a tremendous opportunity for me to start with a small firm and help to build a firm, help to build a record. The environment was unbelievably different from today. Our clients were going to be basically three families, each of whom were monetizing relatively illiquid assets and suddenly coming into about $10 million each of liquidity, which was a much larger sum than it seems today. And so we started out close to about $27 million in the summer of 1982. We weren't even sure what we were going to be. We thought for sure we would be an investment firm, but we were thinking about possibly giving out some money to other managers, possibly keeping some of it in-house, creating an office that would manage the operational side of flipping the coupons and collecting dividends and making sure the books added up and the taxes were paid. So that was the idea of sort of an expanded family office. Obviously, it's had some changes over the years. The interesting thing about that environment, first of all, the stock market basically did nothing between like 1964 and 1982. The Dow peaked to 1,000 in 1964. It was ensconced in the mid-700s in the summer of 82. So basically no return for 18 years, which reminds you all, of course, of Japan, when Japan's even worse over the last 18 to 20 years, which highlights, I think, part of the issue with investing. One of the challenges is you can go an incredibly long time and not make any money, and so long-term really needs to be long-term, as Bruce was emphasizing. The idea of value came to me when I was working at Mutual Shares with Michael Price and Max Heine in between college and B school. It was like being let in on a tremendous secret. I think, as Warren Buffett wrote in the Hermes magazine, the Super Investors, that all of you have read and memorized, I think, it is like an inoculation. Either you get it or you don't. And for me, hearing about the value approach was like a door opening. That I understood the stock market. I've been interested in stocks since I was a kid. But understanding value, really understanding that stocks are not pieces of paper that you trade and guess which direction they're going to go, but rather fractional interest of businesses, is the key concept to all investing and remains as important today as ever. I'm a student not only of the markets and of investing, but I also think of the competitive environment. In some sense, if you know what everybody else is doing, it helps you understand what they're doing right, what they're doing wrong, to learn from them. You can also figure out what ways you might be able to do better. So when we were starting our firm and we had our $27 million, we spent a lot of time meeting with other firms, possibly to invest with them, so we had to figure out whether we were going to get some out or not, and also just to understand the landscape. And we identified certain things about the market that, again, hold completely true today and are frankly quite disturbing, because what happens in the investment business is not what I think any of us would think was going to happen in terms of intelligently investing our money for limited risk and good return, which is what I think all investors would want. Each of us, by the way, are risk-averse people. People in general, virtually all, are risk-averse. If I offered to flip a coin with any of you, we'll take your whole net worth, double or nothing, one coin toss, fair toss. I think you would all probably turn it down because you've gotten to where you are and you don't so desperately need twice as much unless you need like a life-saving operation that you would feel the greater loss of your net worth than doubling it. The benefit would be from doubling it. So we are all risk-averse, and yet the way the investment world is structured is very much with asset-gathering machines who get paid for how much they run, not how well they do. Change a little bit with the growth of the hedge fund industry, but only a little bit. There's still asymmetry in how things work out, and also in terms of even hedge funds get a lot just for showing up. And so the world has this relative performance orientation. Relative performance meaning if you beat the market or if you beat your peers, you will gather assets even if you lose money doing it. When I think about the possibility that I could have to write a letter to my client saying, dear client, after let's say 2008, we had a great year, the market was down 40 and we were down 35, lost barely a third of your money, that's a lunatic letter to think about writing. And yet in a relative world, that's great performance. 500 basis points is exceptionally good. So the asset gathering world, the mutual fund world, has that misguided approach. It essentially means you're going to be fully invested at all times. If you have any cash, you put it back in the market, or you buy an index fund to get back in the market. And so that whole mandate is a little bit crazy. The investment world, broadly speaking, also has a ridiculously short-term, herd-following, trend-following orientation. If all other managers are overweight Microsoft or Google, you have to also, or you will be underperforming if that does well. But mostly, because of the nature of asset gathering, because of the fact that assets are relatively sticky, people want to be deliberately fairly mediocre. That the benefit of swinging big, of trying hard to do well, always involves the risk of doing really not well. And that's a risk most asset gatherers don't want to take because they have incredibly valuable business. And the way that clients think about it is if you're in the bottom decile, bottom quartile, you might get fired. But if you kind of hug the indices, you don't, and you probably continue to gather assets. So you end up creating this giant business where it charges lots of fees, as we know, which destroy any possibility of outperformance, and they're not even trying to outperform, by and large. And when they do, it's risky as hell for them, so they mostly don't do it. So value investing basically works. There's a fabulous piece, if you haven't heard about it already, called, what is it called? It's a Tweety Brown piece.
What works in investing?
That's on their website, What Has Worked in Investing. That's sort of a compilation of like 50 different academic studies about all the different ways to think about value and how basically all of them work. Low price to book, low price earnings, low price to cash flow, dividend yield, and what's down tends to be up the most later. So contrarianism. And it's a great piece. It's highly recommended to everybody. So value investing works. But it works kind of like molasses. So value investing, if you just do a paint-by-numbers version, running screens, buying the cheapest names, you add 100 to 200 basis points a year. And it could not add value for 5 or 10 years. So, like, again, the long-term orientation that Bruce talked about. I thought that while attracted to the logic of value, the idea of buying bargains, the compelling argument, I think that we all live in our lives again when we go shopping. We don't say, what's the most expensive thing? I want the brand. At least most of us don't. We want the bargain. And America is addicted to bargains. So in some sense, we're value investors in all parts of our lives, except, of course, for investing, where people lose their minds and start trend following, like things better when they're up. So we thought we could do better, that how could mindless computer-generated ideas not do as well as actually thinking, actually identifying. For example, the Greenwald concept of net working capital doesn't take into account things it can't take into account, like off-balance sheet items. And yet we can all easily do analysis and figure out the company has hidden liability, environmental problems, litigation, asbestos exposure, underfunded pension funds, or hidden assets like real estate on the books for 100 years that is now greatly totally depreciated and worth a lot, or other hidden gems in there, investment in business that's worth a lot but they don't show up in books, etc. So we believe in an activist approach to value investing, not just paint by numbers. We added several principles on top of that, partly from our view of what the world's doing. One, as I said, is an absolute orientation, not relative. Absolute orientation means that we're trying to make actual dollars, not actual relative performance. I don't really understand why most people benchmark themselves against the market. It seems to me that a sort of an intellectual clarity is to say, client gave me money, so I have cash. And to be provoked to part with the cash, I ought to have an idea that I'm going to do better than the cash. If I think about that, I can keep an absolute barrier from doing dumb investments. If I have a relative barrier, it basically says if the whole market's overvalued, I'll buy the least overvalued crap. And I don't think that's a sound principle. So even though virtually everybody is measured against the market, and when Warren Buffett was running his old partnership, he measured himself and his success against the market. And I can understand these converge over time, that over a long period of time, the market will perform a certain amount, probably a little bit higher than cash, and you want to beat that too. But I still think to keep your intellectual clarity of how you're thinking about deploying money, you would not feel good buying stocks at 30 times when the market was 35, as if that was some kind of bargain, when you know over the long run the stocks trade around 12 or 15 or 17 times, depending on how you measure it. So absolute, not relative. And then you have to write the client that letter on how great you did when you lost a third of the money. Bottom up, not top down. Most investors are lulled into this idea that top down actually matters. It's not even clear in any kind of statistical academic studies that if you knew that China was going to grow at 10% a year forever, that would actually be correlated with good investment returns. The market might go up, but in terms of long-term returns on those companies, it's not clear that growth in the economy actually correlates to the stock market success. But beyond that, we think it's almost impossible for anybody, and I've seen no demonstrated record of success investing top-down. Top-down would basically mean identifying a concept. I'll bet the euro falls. And then you have to translate that concept into a time frame, a magnitude, and then specific industries will be affected, specific companies that might be affected in order to put on your position. And so you've got to be right in some sense about a lot of these things, and you have to be early, because if you figure it out correctly somehow, and it all happens, but everybody else got there first, price matters. The price is, I think Bruce Wilson probably has told you already endless times, one of the most important things about investing is price matters. Risk is related to price. Risk isn't related to volatility. Risk is related to price. So the idea that you would top down, make all these wise calls, and repeatedly achieve success doing that, I think is remote. Maybe George Soros has done that. Maybe he hasn't. But I don't know anybody else that has.
He has not.
Well, there's the word. So
most of his money was made in the sort of things Howie does for him.
Yeah.
He knows it.
So the third principle that we try to follow is to focus on risk before we focused on return. So I was starting to say that risk is not inherent in securities. Risk is not beta. Risk is not volatility. Volatility actually, as we all know from all Graham and Dodd concepts, volatility is a wonderful thing, because if you buy a bargain and then there's a lot of volatility and it becomes a better bargain, you can make more money. Volatility helps you. Volatility is not correlated to risk. Value of something is correlated to its risk, in the sense that if your price you pay is higher than value, you have risk. If your price is bargain, you don't. And I'm sure that it'd be fair to say there are riskier businesses than others, and all investors should take that into account. But again, that's not measured by historical data or any academic concept like that. So we try to think about risk in a world where many people are focused single-mindedly on return. We all know that Wall Street research reports just are, even after the Enron era and more focus on making sure that we write negative reports, they're still basically all positive, and they all have mistakes in them, by the way. And there's just a difficulty in the market with when everybody is compensated based on how much they earn. Even to the point where I think it lulls to sleep some of the brilliant endowment managers and other takers of the investment product, that at the end of the day, they can only measure their results, really, by return. When they bet a vat of clam chowder against a vat of something else at the over tailgate, they are betting on who had the highest return. And I think it's a shame because they all know that risk has to be an element of the thinking, and yet it's hard to measure risk. If risk isn't beta, which I am adamant that it isn't, and all value investors understand that it isn't, then what is it and how do you manage it? How do you measure it? So we think about risk as how do you lose and the chance of losing it. We're probably not as risk averse as Bruce described, by the way, so you can cross out those parts of your notes. We are intensely focused on risk, but it doesn't mean we don't take it. We try to make educated bets. When we find a bet that we think is hugely in our favor, I'm not talking about a bet like a Goldman Pulse and CDO trade, but rather do we buy this bond at 20 that we're sure is worth 50, but there's always a chance we're wrong, and that kind of bet. When we find something absolutely compelling, perhaps a senior security, a catalyst to realize the underlying value, a management team we can trust, or a situation that we can develop confidence in, we will make an oversized bet. So we have 10% positions in our fund, just as Bruce was describing with my friend Glenn Greenberg's fund. But we do think about risk in a kind of obsessive way, both in terms of specific investments. We want to understand what we're really betting on. We don't want to glibly assume that it's a simple bet when it actually is much more complicated. We are aware, for example, that P's or multiples can change in the future, so you wouldn't want to say, I'm buying this at 20 times earnings and the growth will be really high, so in 10 years it'll still be at 20 times earnings and look how much I'll make. At 20 times earnings implies high growth, and therefore the multiple might be a lot lower in the future. So we try to be conservative on all our assumptions. We run sensitivity analysis. We think a lot about risk every which way. But we are not avoiding all risk. We're not market neutral. We don't short heavily because there's unlimited downside in shorts, and it's an art, and you have to really focus on that. I also think short selling involves a shorter term orientation than going long. And if we were big short sellers, it would inevitably shorten our time horizon to match that of the shorting on our longs, and that was a big mistake. So, all of that said, here's what we basically try to do. We have an incredible team that's grown over the years. The team hunts for opportunity. We think you have to be clever about how you fill the inbox. There are two things that are scarce for all investors. Capital is always scarce. You never have as much as you might want, or rarely do you. And then the biggest scarcity is time. You could look at everything, and you need to winnow that down to what you're actually going to look at and where you're going to dig deep. So we'll try to fill our inbox with what is most likely to be mispriced. So what causes misprices? Well, I think one way to think about that is that mispricings are driven by human behavior. They're not driven by the companies themselves, other than news about the companies or events of the companies that causes human behavior to misprice things. So mispricing, I think, is driven by emotion, which will always be present, which is why the markets will never be efficient. We'll always have mispricing, because it's driven by human beings, human behavior. Mispricings, in particular, are driven by fear, by surprise, by complexity, by stigma. Right after a major bankruptcy in an industry, if people think there might be an industry-wide problem, no one wants to go near that. A long time ago, Union Carbide had a horrible chemical release. It killed a lot of people in India. Nobody wanted to own Union Carbide, regardless of whether it was cheap or expensive, regardless of whether you could pinpoint reliability and whether they had insurance and how it would all turn out, because you had to explain to your clients why you own that. Most people don't want to own a bond that's in bankruptcy because you look stupid. Clients will say, why do you own that bankrupt bond, especially if you owned it in par and now it's at 20 or 30. So when something goes bad, in some sense, it gets oversold because of that stigma, because of that client looking over your shoulder, your boss looking over your shoulder, your conscience looking over your shoulder, so people will oversell. One way to think about that is very simple. Like bonds are really interesting instruments. Bonds are a wonderful, safe instrument in the following context. They often can be senior securities, you're first in line. contractual terms, you get interest, you get principal back, you know when you're getting those things back. And so there's an elegance to bonds. The problem is everybody knows that, so they don't return very much most of the time. But when a bond suddenly gets downgraded from investment grade to not, the rating agencies know what they're doing, but forgive that for a minute, people actually panic or can't hold the bonds. There are funds whose charter says, I will only own investment grade bonds, I will not own non-investment grade bonds. So if your bond goes sort of arbitrarily from triple B to double B, you have to sell. And that day, there might be a lot of selling in the market and no natural buying. In some sense, that's a supply-demand balance. Selling that has to happen, buying that may or may not happen, but doesn't have to. Think about an index fund. If a stock is in an index, something like 10% of the market has to own it, because that's how much the indexing activity is in the U.S. with, let's say, the S&P. If the stock gets kicked out of the S&P 500, that afternoon, 10% of the company has to be sold. And that stock probably is a dog. It's underperformed. It's down from 30 to 3. Its earnings are probably negative. It's omitted its dividend, so it already is dated. And now the 10% of it's available for sale, and there's nobody who has to buy it that day. Just people have to sell it. That's the kind of mindless selling that gets us very interested. So we direct a lot of our efforts to looking for bargains that way. That has led us over the years to distressed debt, corporate spin-offs, which are very much like the stock that was kicked out of the index. A company says they're going to separate into the parent and this little lawful subsidiary that has litigation, or has low returns on equity, or has no growth or something, and they cast it off, and usually without a roadshow or without a secondary offering of any sort. And that stock often trades terribly for a while because there are all these people that got it that want to sell, can't get any information on it because it's not in the databases yet, that can't make it a meaningful position, that don't know what it is, so it gets dumped. And again, people choose or have to sell, and nobody has to buy. So what I'm really describing is our fishing ground. We look for opportunities where there are these conditions. We do other things too, but that's, I think, it's important to fill your inbox with things that are likely to be mispriced, not things that are likely to be efficiently priced. So that's why we look where we look. It's also, I think, just incredibly important to remember that psychology is really important, that other people's psychology is important, the market psychology is important, and your own psychology is important. I think in many ways that investing is like the intersection of economics and psychology. So it's important as hell to be a great analyst. It's important to understand business, economics, to be able to crunch the numbers, understand what something's worth. But if you don't understand the psychology out there, you may be buying something at a very inopportune time. To understand that what the other people in the market are doing, why it's coming under huge pressure, or why it could be about to come under huge pressure is really helpful. Your own psychology also matters. That one of the things that I think happens to a lot of investors is they believe what they're doing up to a point, but there's nothing like staring at large losses and a very sharp down market and a lot of fear in the world. It's very hard for people who aren't genetically inclined to be value investors to sort of hang on and do the right thing when something goes down. Intellectually, everybody that knows gram and dot understands that you compare price to value, and if the stock goes down and the value hasn't really changed at all, it's a better market, and you want to be buying more. But if you're not emotionally conditioned to buy more when it's cheaper, if you're emotionally conditioned to, oh God, I paid 20, now it's at 15, then it might go to 10, then you're going to be a lousy investor. Guaranteed lousy investor. What's weird is that most of what I described earlier about the way the world works conditions everybody to be trend following. That if you are relative performance oriented and things are falling rapidly, you might start to feel like, well, if I could just get out of the way of this, maybe I'll outperform a little bit. So, and I think we see this in the market. We clearly saw it in the fall of 08. As the lower it went, the less people like stocks. That also certain things happen where if you're down a lot, maybe you're going to get redemptions, or maybe you're just going to be afraid you're going to get redemptions. But being afraid of them is the same as getting them if that causes you to go to cash. So a lot of managers got less and less and less invested as they went through 08. They probably started the year leveraged, and they ended the year with net cash. And that happened many, many, many times. Similarly, when the market's rallying, people start feeling terrible about their underperformance. They're relative performance oriented. So the more the market goes up, the more they start to see green shoots, even if they're not there, or if they're not sure they're there. And as the market rallies, if you're underinvested, you feel this huge gun to your head to put the money to work. That one of the beauties of our firm, I think something that we got lucky and probably intuited a little bit, was you can't think straight with a gun to your head. So if you have a relative performance gun to your head, on the way down and on the way up, you will do the wrong thing every time. Guaranteed to get it wrong. You will be liking them when they're up, and you'll be hating them when they're down, when you should be doing the opposite, and we all intellectually know that. So we are, I would say, resolute, if not stubborn, at doing the right thing. One of the things we try to imagine is that we are Warren Buffett. Not because we follow his strategy, not because we're rich like him, but because he manages his own money. He has no real boss. He has no undue pressure on him. There might be an annoying newspaper article. He's able seemingly to ignore all of those. So Buffett does not say, how will it look if I put 10% of my money in this? Or how will it look if I bought it yesterday and I sell it today? All he's worried about is making good investments. Most managers can't do that. Most managers feel pressure to do far more than that, which in a sense causes them to play a very short-term oriented game. The only way to do well over the long term is to ignore the short term. And what I specifically mean by that is the market, as we know from Graham, should be thought of as Mr. Market. Mr. Market sometimes is ebullient, sometimes depressed. And so when Mr. Market is ebullient, he will overpay you for what you own. But it only works if you sell it to him. And the only way to do that is to sell and go to cash. If Mr. Market is depressed and wants to sell you something at a huge discount, you want to buy it. The only way to benefit from that is if you actually have money with which to buy it. If you're fully invested and down a lot, you can't buy it. You already own it. So I think that alone implies at least a willingness to sell things when there's no replacement and to buy things up to the maximum amount of cash that you have. The relative performance pressure that people feel causes them to desire something that is impossible, causes them to desire short-term outperformance. How do you achieve short-term outperformance? What would you do? If, let's say we're all 100% sold that buying bargains make sense, thinking stocks as fractional interests make sense, we're going to buy these discounted securities and make money doing it. How does that connect to the short term? And I would submit that it doesn't connect to the short term at all. That if you are focused on how do I make money by the end of the year so I can report a good result, I don't think you can buy these discounted securities because they might be more discounted. They might just sit there. A lot of value investing is like watching paint dry. And Paul Sacco was lamenting to me on the way over how some of these really cheap stocks just sit there. And that's understandable. They get cheap for a reason. They're growing business. People don't care. There's not a lot of money going into them. And that can last for a really long period of time. Trying to do well in the short term means you're playing a different game. You're suddenly not focused on value. You're focused on trends. You're focused on trading aspects. And I think almost ensures that you won't have a good long-term result. So it's sort of an irony that most of the world focuses on short term, cleaning up all the time, and that almost ensures that you can't be up over a long period of time. We have certain other principles that we try to follow in terms of thinking about how to run our firm, how to run our portfolio. As I said, one of the big differences we have with many others is we're willing to hold cash. That we are not timing the market by holding cash. We are timing opportunity by holding cash. There are lots of bargains. Even if we're bearish about the world, we try to never let our broad view of what's going on influence us. We can have bearish views, but we know that we're not good at turning that into making money. We can have bullish views. We don't usually, but if we did, we would not be good at turning those into making money either. Rather, we want to remain bottom-up oriented, bargain focused, and if we find bargains, we buy them, and if we don't, and we do, I think, quite a good job of reminding our clients that that's what we're doing too. Now, people say to us often, well, why am I paying you to hold cash? Clients will say that, but students will say, why would your clients want to pay you to hold cash? They're not paying us to hold cash. They're paying us to steward their money prudently and sometimes that means we can't find bargains. There's no reason to think that today's opportunity set is the only one you'll ever see. That unless you think you're going to business next week, we have today's opportunity set, we have tomorrow's opportunity set, and we have the next 5 or 10 years opportunity set. To say that you had to look only at today's opportunity set and therefore be fully invested all the time would sort of be like saying you have to marry somebody from your high school graduating class. That's not the whole opportunity set. So other principles include no leverage. In that sense, we're massively risk averse. That if we can't make money unleveraged, we'd rather go out of business. We never feel pressure to maximize return, trying to maximize risk-adjusted return. But the risk of leverage is that it's like drowning in a pond that on average is 1 foot deep. That one day in 2008, when all hell breaks loose, you could go under, and it's just not worth it. There's no amount of incremental return that makes that worth it. So in that sense, we're highly risk averse, and we've never leveraged the portfolio. The only debt we ever have is on our illiquid investments, where we might have non-recourse debt on a building or something, but it's non-recourse, so if the worst happens, we just give them to build it, but we never expose the portfolio to 100% loss. We believe hugely in home cooking, so we put 100% of the employees' net worths right up alongside the clients of the firm. All the partners' money, all the family's money is invested, essentially, virtually all invested at Outpost. And we are passionate about that. Client asked me recently, would that possibly make us more risk averse? And I said, I hope so. that if that's not comfortable, if clients want managers to take more risk, we're the wrong manager for them anyway. One of the things that every investor should be able to answer, I'm telling you too late for this class, but you probably figured it out on your own anyway, is we have to be able to answer, every investor has to be able to answer, what's your edge? It's amazing how many managers say, I'm going to start a firm, and I'll be a long, short investor, and I'll make lots of money for my clients. Like, why? What will you do better than average? Given that there's thousands of smart people, 10,000 or 8,000 hedge funds alone, lots of other investors one way or another, all looking for opportunity. I think that every manager must answer it. It's amazing how many either don't think that way or can't. Our answer for us would broadly be, and no one of these, by the way, I think is sufficient to think that we have any edge at all. So we need a lot of them working together. But we have great clients, which lets us have a long-term orientation, which is probably the biggest edge any manager can have. During the crisis in late 08, we were able to buy highly illiquid messes of securities, what were basically called toxic assets, at IRRs as high as 50% with almost no risk. Could have traded down, by the way, and that's a critical point. That one day we were offered a security that it probably had a mid-20s to high 20s IRR based on our conservative modeling, again with very limited risk. And yet it was very illiquid. I think that the market for it may have been quoted like 30, 35, and the seller offered to sell it at 40. And we ran the numbers and said, we'd rather buy it lower, but at 40 it's still a low 20s return. How many managers would have been comfortable saying, buy it? Because we know intellectually low 20s is unbelievable. We're also paying 5 or 10 points more than the market, and we know that the quote at the end of the month is probably going to be 30 bid. This is illiquid, who knows? And you have to explain to your clients why you just lost money when you actually just made money. You make money because you find something at a great return and will earn it over time, but only if your clients stick with you. And yet your mark-to-market is you're an idiot. But if you have no chance of buying at 30 and you can buy it at 40 and earn a great return, why would you do that? But only if you have those long-term oriented clients to support you. So having long-term oriented clients, in some sense, lets us take a long-term horizon. Also, our kind of, I already acknowledged it, our stubbornness in trying to do the right thing and spending a huge amount of effort educating our clients what we're doing, which basically enables us in some sense to have them on our side, to have them say, let me give you another example. Let's say that we have a portfolio full of bargains. We're going to have 15% returns with very limited risk on debt instruments. and the bottom falls out of the market, and all that goes to 20% returns, which probably means prices are down 10, 15 points across the board in that portfolio, which means we're probably down 15 to 20%. We've actually never had it drop that much, but let's say across the board, our portfolio dropped. And nothing was wrong with the analysis, that it was simply urgent selling, people getting redeemed, people getting margin calls, whatever it was, selling, selling. We want to have clients who, when we call them up and say, we are seeing the most unbelievable opportunity, we have these incredible bargains, and they become much more incredible. We want clients who are going to say, that's great, how much money should I wire you? We'd love to take advantage. Because if the clients are going to do the opposite and say, yeah, Seth used to be a good guy, but boy, he's really lost it. It's a disaster. We now have to sell these incredible bargains and getting more selling and driving the market lower. Obviously, this doesn't take into account that we might have lockups and notice periods and things like that that will prevent the clients from doing harm to themselves. But clients can't always help it. That they do, since they don't know the portfolio the way we know it, and this is across all their investees, clients can overreact. Clients can panic. Clients can have their own disaster, as we know many university endowments did in 08 and 09. So having the clients we have, who've mostly been with us a long time, who are not who control their own fate. They're not fund to funds where doctors and dentists can redeem, causing them to have to redeem even if they don't want to. They're not flaky. They're not subject to the kind of legal restrictions that a pension fund might have. They're not subject to global political matters like a sovereign fund might have. So having clients who are either wealthy individuals or U.S. endowments is of great comfort to us, in addition to the slight addition that managing great endowments and foundations makes us feel good, because if we do well, we're also benefiting those causes that are underlying those pools of money. We have great flexibility in our mandate. I think if we had to point to a second most important thing, it's that. The way to think about that is, if you have a narrow mandate, if you're siloed, you will be looking all day long at REITs, all day long at utility stocks or energy stocks, or stocks as opposed to stocks and bonds, real estate and derivatives or whatever. And if your mandate is narrow, you're likely to be doing things in that area, whether or not they're actually very mispriced. So you can be locked in someday in a unfertile field when there are other fields that might be much more attractive, but your mandate doesn't let you look. It's hard to get that mandate. Most clients say, I don't want you just doing anything. I want to know what you're going to do with my money. And yet, what is compelling in our minds is we don't know what we're going to do with your money because we're looking for the best bargains. And so that's something that takes time to contract with your clients, not a legal document, but in terms of understanding that you're actually good at that you're not overreaching, that you're not thinking you're good at something you're actually not good at. But it's really helped us a lot as our firm has gone from $27 million to over $20 billion, as we've gone from being basically a domestic equity and distressed debt investor to an investor, domestic and international, in equity, debt, structured products, mortgage securities, and private assets. So that's been our 28-year evolution across asset classes and geographies. That flexibility is critically important. The way I would describe it, also our team approach internally makes a huge difference. That we work as a team. We basically want money to slosh into the best opportunities and out of the worst, most overvalued, or less interesting areas. Now, if we had 3 analysts at our firm, say 3 of you, and there are firms that would say, well, why don't you run $100 million and you take 200 and you take 300? We think that's kind of insane. And it's not because you wouldn't be the most talented analyst we can find and gifted in your own way. It's because you're not talking to each other. That handing people money and saying, do your best, basically misses that maybe all of our money should be in your ideas. Maybe those guys' areas are dry. Often firms divide up by industry type or other similar ways. And so even if you each have your best ideas put to work, one set of ideas may trump the others, and that may change dramatically next month or next year, and then we should slosh over your ideas. So by talking internally, by communicating openly, where are the best opportunities, we think we're basically, as value investing does, taking less risk and earning higher return. less risk because we're in fewer fully priced, overvalued ideas, and out of infertile areas and sloshing money quickly into the most fertile opportunity. And so that is, in a sense, what we're doing as a firm also with our flexibility. That if real estate's attractive, we can be big in it, and we can be big in it in any way, shape, or form. We can own REITs, we can own debt and convertible bonds on REITs, we can own debt on REITs, we can own bank loans on buildings, we can own non-performing bank loans on buildings, we can own municipal bonds backed on buildings, we can own mortgage securities, we can own commercial mortgage securities. So buy raw land to build a building. We can own real estate any which way we want. How am I likely to do well in real estate? By only buying REIT stocks and figuring out which should be long and short, or by looking at the same goddamn building and owning it the cheapest way possible. Sometimes, like right now, you can potentially, although not always, but periodically, buy buildings at sort of a third to half off of where you buy them by buying a REIT. I'd rather own them that way, and I think all of you would too. Culture is unbelievably important. It's hard to rank, but our culture sort of makes our firm work. The culture is highly collaborative. It's cooperative. We reach across the firm to share information, to look for the best opportunities. When the public side is very busy, the private side is applauding that the public side is finding great things to put money to work in. When the private side is busier, finding commercial real estate as they are right now, the public side is pleased as punch. And because we're all clients, and because we all share a common pot of bonus money, whatever area is most fertile means we're getting the lowest risk and the best return, and the money's doing that. We also are very, very careful with hiring. We want to get people that are not only great talents, but a great fit. We have a no asshole rule that we follow rigidly, and assholes are asked to leave as soon as we identify them. We do not have a common definition of that, however, we're pretty good at identifying it. We share the wealth. We have a very clear understanding that whoever contributes to the firm's success will be big sharers in it. We never want to rise up the ladder and have partners who then pull the ladder up behind them. Rather, there's no limit to how many partners we'll have over time, and everybody understands that their personal wealth and success is enhanced by sharing with other people. Relationships matter a huge amount, not just with clients and with peers, but especially also with the street and with sourcers, people who would identify opportunity for us. So on the public side, that's the street. For example, in distressed debt, the street, by the way, is usually completely useless, if not dangerous, albeit it's sort of obvious that nobody should be trusting anybody in the street to give them good advice or look after their interests. You have to do that for yourself. But rather, for example, distressed debt, if a bond is at 50, it potentially is interest at least. And you don't need a genius broker to cover you. They can tell if it's at 100 or 50. So when they call you and say, I've got a bond at 50, I have no idea what it is, that's an idea that filters into the firm. And then wherever it comes in, that would come in through a trader, it gets handed to the head of the group that would be relevant, who hands it to analysts, usually senior and junior analysts who work on it, filters back up to the head of the group, and then to me for basically good housekeeping seal of approval. And that's how we would follow an idea. And those relationships are unbelievably important, especially for a firm like ours, which historically has been smaller than a lot of our peers, less well known than a lot of our peers. So we work really hard to spend time with key brokers in various areas of interest to say, just staying in touch. You know that when things are cheap, we'll be your best customer. We'll stand there buying when everybody else is out of the market, getting redemptions or panicking, whatever they do. And at the same time, we will be your most annoying, worst customer when the market's up, because we're not going to do much. We're just going to be kind of sitting around, although we will be selling for a while, then it'll go higher, and then we'll just be out and waiting around. And yet, they can deal with that. We're not the biggest commission generator by far on the street, but we work hard to cultivate those relationships. I think for brokers that are in it for more than 1 year's bonus, which is some of them, that they will work with us on our terms, and it leads to some very long-lived relationships. And when the markets come our way, it leads to great sourcing of opportunity, both in terms of new ideas, but also just flow. that if we had a great idea, combining it, but it doesn't do us any good. So brokers that would say, well, let's call it Baupost, it's really valuable. And so when we're looking for something, at the same time, that's what brokers would treat our ideas confidentially, because our biggest stock in trade is our ideas. It's the one thing you can't risk being known, which is why our annual letters don't really talk much about our names. We can't share that for obvious reasons. On the private side, similarly, sourcing is valuable, perhaps even more valuable. And by that I mean that in real estate, which is our biggest private area by far, we are looking for troubled property. Something is wrong. Rents are falling below where the cash flow covers the debt. Debt is coming due, it can't be rolled. Property is emptying out, a single tenant is leaving. So we tried to convert apartments into condos and it failed, and it filed for bankruptcy and needs to go back to being apartments. Something happens causing financial distress, causing the exact same kind of supply-demand imbalance that I described on the public side, but it's one property. Just as a stock can be overvalued or undervalued, so can a building. And we value enormously these relationships that we've had for 15 or more years of people that specialize in something. Hotels globally, apartments in the Southeast, warehouses in New England. Those kinds of relationships know what we're looking for and pop up deals. Some are interesting, by the way, some are not, just exactly like public market investing. We try to have the relationships understand, and in some sense, our edge there in particular, other than being nice people, is real estate's a slimy business. A lot of people will say, I'll do this, but at the closing table, don't show up with money. We have a reputation for 100%. When we say we'll do it, we do it. We've got billions of dollars sitting in cash, so we don't need to go raise the money. We don't need to make false promises about the money. We say we'll do it, and we have the money. We have partners that add value. We have a very experienced real estate team, and so if we are aware of a tenant that would fill an empty space in a building, or aware of a financing opportunity to take cash out and de-risk a deal, non-recourse, we can do that. If we have an idea about how to reposition a building to achieve more success in the market, we can do that with a lot of market knowledge, market color. So we try to tie our real estate partners to our firm as well. So these aren't all the advantages, but these are many of the strengths that give us the possibility of outperforming. I also think, and I would go back to Bruce's point about risk, that we are ever vigilant. I think all of us are on the humble side, that we've been very successful, and we know it can be taken away from us in 5 seconds. You don't read about us as much in the newspapers. That's not completely an accident. We can't control them, but we certainly go out of our way not to be known unless we have to be known. We'd rather be below the radar. It doesn't do us any good if everybody's trying to follow us and copy us and stealing our ideas. So we try not to ever let success go to our heads. Our success is not because we're so freaking clever. Our success is because we work really hard. We follow an intelligent process and all these other things that we've worked really hard to create over 28 years, and we can screw it all up. If we blow our reputation next week, we might as well go out of business. So we work really hard on that. In a sense, all of that is managing our risk as a business. At this moment in time, we're sort of stunned. And by the way, anything I say at all that's to do with a macro thing is a pure speculation on my part. We would never invest based on it, other than hedging based on it. But I will say, I think that this is a very weird time in the world. That the world ended, as most investors know it, in 2008. Massive declines. People almost certainly were saying to their religious being, I will never do that again if you just save my portfolio. I will never leverage, I will never mismatch borrowing with my assets. I will never speculate on stuff I really don't know anything about, et cetera, et cetera. People were certainly doing that. And today they are right back at the exact same level of speculation as before the collapse, if not more, in many cases. We, as I wrote in my year-end letter, I don't know if that was distributed, there were easily, we just came up without thinking that hard, 20 lessons one might have drawn. There's probably another 200. And I think virtually none of them have actually been learned. the short-term pressures that existed before that caused people to be massively leveraging, to be buying weird structured products. So while they might not have thought they were leveraging, they in fact were leveraging. It caused endowments to commit 1.75 times the amount of money they wanted to liquid, so they ended up with 1 times the amount. All those things are basically back. Those same pressures. The only group that seems to have learned anything because they were hurt the worst are probably the endowments. And even they have benefited by the stimulus in the sense that a lot of private equity is being bailed out, that the losses would have been, in many cases, 50 to 100% of the money committed, and the losses now look like they'll be less as companies that were walking dead a year ago are now refinancing and surviving somehow. The ferocity of the rally, on the one hand, isn't that surprising that the worse the decline, it may overshoot. It probably did overshoot a little bit, although it never became as ridiculously cheap in terms of the equity market as it has at any other similar disaster low. The ferocity of the rally suggests perhaps a degree of over-recovery, maybe a mindless knee-jerk reaction based on performance pressures and short-term orientation, rather than actual fundamentals that say everything's fine. And in some sense, I find it just a giant disconnect that there is, again, in my mind, a giant experiment going on where the government has said, we can't stand a downturn. American people will not stand for it. It's not a natural condition, even though, of course, it obviously isn't. Capitalism is a downturn. So we will eliminate that just by the way, as Alan Greenspan has for a decade plus before, basically lowering rates at every opportunity, stemming any decline, but building up excess that blew up in 08. I mean, I would reliably place over 50% of the blame right at Alan Greenspan and Fed policy, although I would probably assess blame well over 100% as I was thinking about all the guilty parties. But that's a big one. And yet we've basically recreated the world as it was before the collapse in many ways, with the exception of the amount of leverage in securities. There's no CEO squared, I think, happening right now, although I'm sure it won't be far behind if the market keeps going up every day and inflows keep happening. And by the way, that's another sort of trick that Wall Street tends to, at some level, like mutual funds and other money managers hold themselves out as the prudent, responsible people. But the reality is their bosses say to them, we got inflows, you got to find something to do with the money. So in some sense, they're actually not taking the time to be thoughtful at all. They're basically monkeys with money, just looking to put it to work in the least objectionable way they can, not necessarily with any discipline or any prudence that a normal adult supervision might suggest. So I would say, just broadly speaking, we are just very worried that when we look at the world, we say, maybe there's a recovery, maybe it's even a V-shaped recovery, but maybe there's not a recovery. Maybe this is all stimulus and one-time tax cuts and cash for hunters and cash for talkers, and now there's appliance rebates somehow. I'm not sure why we're getting those. And I think we just don't know what the underlying level of economic activity is. There's a lot of inventory adjustments, a lot of government statistics that seem very funny. So it's very hard to know what's really going on. Even the optimistic government that always seems to be erring on the side of optimism says unemployment's going to be massively high. It may take 10 years to get back to kind of a 5% unemployment rate. So that suggests a huge amount of drag on the economy. Deleveraging will be drag on the economy. Higher tax rates will be a very big drag on the economy, or those parties that pay taxes. So I think it's just very hard to make any kind of earnings estimate guess. Now, I would also say I never have an earnings estimate guess. Value investors try to buy what's here today and don't have brilliant ideas about the future and realize how dangerous it is to speculate about the future. But I think the band of possible outcomes is just wider than usual. And also, I think that what we see going on in Greece is kind of a metaphor for what's wrong, that we patch up corporate problems and consumer problems, but it ends up transferring to the federal government. Most governments' debt to GDP ratios have gone up massively over the last couple of years, and yet there can be a tipping point that one day Greece was okay, and they could refinance and not pay that much. And the next day, it just wasn't. And there wasn't anything that particularly changed that I'm aware of. Greece is Greece, but the perception of Greece changed. And I think the perception of UK could change, the perception of the US could change in very onerous ways. So I think it's just a time to be aware of outcomes outside of the range of anything we've experienced. Warren Buffett was looking for a successor. He said, I want somebody who can think about and imagine and deal with scenarios that have never occurred before. And I think that's very apt. I mean, Buffett says that it's apt, but I think he perfectly nailed that. He said that like in 06 or 07, and it was clear that by 08 we had scenarios nobody'd seen before, and his successor wasn't in place, but had they been, they would have had to be equipped to deal with that or in order to get through that. So we're not seeing much to buy. We have a fair amount of money invested in distressed debt of various sorts, including performing corporates, but we've reduced that quite a bit. Bankrupt corporates, mortgage securities, and other structured products. Maybe 8% of equities, maybe it depends a little bit by entity, but about 12 to 13% in real estate, maybe 5% in other private, and about 30% in cash. It actually surprises me that cash is that low, given the magnitude of the rally, because we're willing to hold it, and our investments need to meet an absolute hurdle to get over it, to spend the cash and buy those investments. It's actually a testament to the remarkable job that our team has done finding bargains in an environment that's becoming increasingly picked over and expensive. But if nothing changes, the market stays high, I'm confident that the cash will build to 50% or even more in the next 6 or 12 months. So that's our firm. I'm going to open up for questions. We have a half hour, a little bit more, and I'd love to answer anything that I can.
You know what I'm going to do? I'm going to let you guys raise your hands this time. We had a new procedure last year. They submit questions, and I read out the useful ones. But I think just for comparison's sake, go ahead and raise your hands and ask and stuff.
Sir.
In your letter, you talk about catalysts, the role of catalysts in the investment process. I'm curious if you elaborate on that a little bit more, and you were fine that focusing on having catalysts for investments means you're just good opportunities.
So we don't only have catalysts. We like catalysts. A catalyst is basically something that is happening within the company or within the situation that causes value to be realized. So I think. In many ways, I think it has to do with personal comfort. One of the things about equities is they are subordinated to debt. They're kind of the residual that collects if there's anything left. And so a pure equity portfolio can go through periods like 08, where the market can be down 40%. And it doesn't have to recover by 09, that you can be down 40% for a really long time. So I talked about psychology before. And I talked about the market psychology. But let me talk for a minute about your own psychology. So if we are down 40 because we own bargains and the whole market's down 40, and of course little crappy value could be at 50 or 60, we will feel like idiots. We will start worrying, as I referred to, about whether our clients are starting to think we're idiots, and it will handicap us greatly from being able to take advantage of bargains. When the market's down 40, there are probably things down 80 that are really interesting, and yet how do you have confidence the cash will be there, and then every time you buy something, it goes down, it reminds you of how stupid you are and how much risk you're taking buying great bargains. Because it is risky if you won't live to see the day when they materialize and to realize the underlying value. If I buy a stock at 10 that is worth 20, think about this, and the stock gradually gains ground, a turnaround in operations, there's corporate earnings, the stock goes to 17 or 18. Now think of two scenarios. One is I sell prior to 20. I'm not greedy, and that is in fact our discipline. The risk return changes. When you're buying a 10, it's worth 20, you're buying 50 cents on the dollar, you're getting a great bargain, it goes to 8, it's a remarkable bargain, it goes to 6, you stand there and buy the whole thing. And you can even be your own catalyst by buying control if you want to do it at 6. As it gets to 15, 16, 17, you've got 3 or 4 up, and you've got however much down you think you have, 6, 8, who knows. So the risk return changes a lot. So we try to be fully out of things 85 or 90 cents on the dollar. Can't always be precise, and you don't always know what the dollar is, but you want to be out before it's full. So now 2 scenarios. One is we weren't greedy, we were disciplined, got to 17, 18, we're all out. And then they report bad news. freeze, or the turnaround didn't continue, or it was terrible, stock goes back to 10. How do we feel? That's our psychology. First of all, we're probably pretty happy that we sold it. Second of all, we're sort of, probably we're saying, well, that's not that surprising. The company's a solid business, and it happened before. And this was good to us. We were right that it was what we would believe that we were right. It's worth 20, and it's trading 10. We should buy it again and load up. So at least make the same money again if we can, if not buy more. We know the matter, we're more confident with history. Now take the other scenario. We're greedy as it goes up, we love it more. We now think it's worth 24, we don't sell it. Or we just wait for 20 and 8, so we wait and we don't sell. It goes back to 10. How do we feel? Well, if you're at a typical firm and you're the analyst, you're like, oh, my boss is going to yell at me. And your boss is actually yelling at you. And you start to feel like an idiot. And instead of maybe buying some at 10 because you're actually confident that over the long run, over a year or two, it's fine, you probably might even be pressured to sell it. So the psychology matters enormously that way. Catalysts, as well as self-discipline, buy discipline, can take some of the pressure off of that deep undervaluation that is destroyed in the very short term. When I buy a debt instrument, as I was describing earlier, with yield 20, 25%, I don't actually care very much. If I'm highly confident in my analysis and there's not a wide band of outcomes, I don't care if it falls, because that has a hard catalyst. That is, as I said, in a different context, that is wonderful. Pay me my interest, pay me my principal, pay me my mortgage amortization payments, or I will take control of those assets. In equity, you will do no such thing in most cases, and so you will suffer, and perhaps, since it's so hard, not have clients who will understand, who will think you're an idiot who lost 40% instead of the brilliant analyst who wants to get covered to those positions. So those kinds of things make me prefer catalyst. Catalyst gives you a shorter average life. It means that your outcome is not dependent on the market going up. It's dependent on being right about the situation. And duration is a powerful concept in investing. And I don't want a 6-month duration like I was doing risk arb deals, because if I'm talking about bargains, the bargain is it was trading 19, I got 20. Maybe it was 18 and a half, I got 20. So you don't really ever make very much money, and you make one or 1.5, and you lose 10. So it's a very tough game. You got to be right. You got to be right 88% of the time or 92% of the time. It's maybe the difference between being good and bad at that. But if I can buy debt where and it doesn't have to be debt, but equity where there's nobody else ahead, but where there's a catalyst and nobody back my money, I'm first in line if things go wrong. I may have covenants that protect me. I can buy with confidence, knowing that if I spend $1 today, I will in fact get something like $2 in 3 years or 4 years, and that makes me feel confident that I don't need to worry about what anybody's going to think, because we will in fact deliver the results we expect. You can own undervalued equities for a decade or more, but it took the market like 25 or 30 years to get back to the highs from 1929. So that's why I like catalyst. Yeah.
If you wrote another book, what would you write about?
For another book?
Yes.
People have suggested I should write The Safety of Margin. For optimistic times like now. I've thought about that a lot, actually. There's of course the easy way to write a book, which is to glue together all my year-end letters and say, here's a real-time example through history of how we thought about things, and there are some useful long-lived points in those letters. But probably I wouldn't do the easy route. I would do the harder route. I think that there's a sequel to Margin of Safety that involves there's no new philosophy, but the new asset classes and approaches and securities that we are interested in. So there'd be chapters about real estate and illiquid assets, and Margin of Safety in that, Graham and Dodd in that. Kind of like what I wrote about a little bit in the preface to the 6th edition of Security Analysis. International investing would be a section. Structured products and derivatives would be sections. There are lots of things that can be mispriced. The more things they create on Wall Street, the more possibility of opportunity. I think that Graham and Dodd, I didn't meet Graham and Graham, but I'm fairly confident that he would have thought the same thing. That if you think that value investing is simply about, and even for Graham, it wasn't just about stocks. So if you think it's sort of simply about stocks, when to buy them and when to sell them, I think it understates what he was saying. And it's why, in some sense, Moneyball is such a brilliant book. Moneyball is basically value investing for baseball. And it was a way of thinking that suggested that human nature causes overvaluation, undervaluation, leading to mispricing. So if you're a baseball GM, you take advantage of the exact same opportunities with baseball players that I take advantage of, or Graham took advantage of in the securities markets. That is, it's just a, I mean, I believe the principle in some sense would apply to crazy startup internet companies with a very different, in a very different sense, that the opportunity to be able to sit in your garage and in a month have a business plan for something that's never been done before is something that the internet makes possible, as never was possible before. The ability to reach millions of people, and the ability to start a company virtually with very few assets, et cetera, et cetera. I wouldn't have any idea how to do that, but I could believe that there's massive mispricing in that because people do what's exciting and people stay away from what's controversial. Or some people are smart about maximizing their price by meeting all the venture capitalists and being well known and spinning a great story. And other people might be brilliant idea people, but not articulate. So I'm not suggesting I would do it. I don't think any of us should do it. But I could believe that that's an inefficient market, just like baseball players. So, you know, again, not everybody's a baseball fan. The principle of Moneyball was in effect that baseball talent was evaluated off of wrong statistics, but the same ones people have followed for generations. So people look at batting average, not on base percentage and stuff like that. They believe that if you are an athlete, you should look like an athlete, and if you're a little bit dumpy, that you might not be good. But so dumpy people were undervalued compared to athletic-looking people who might have been overvalued, and maybe even not any better or even worse. So I think the principles are broad, and I think that it's also nice to know that Graham was a Renaissance man. Graham was a genius in many, many fields. And I think it's sort of beautiful to know that he was talking about sort of a watching paint dry way of making money, and he was talking about a lot more than that, sort of philosophy.
You spoke a lot about the quality of your research team, which really enables you to have a flexible mandate so you can slosh money around. But if you're starting out today as an individual investor, how would you balance the desire to look far and wide for great opportunities with the limits of your time and your expertise?
Yeah. So if you're trying to start a fund yourself, you have to limit it, or A, people have no confidence. How could one person follow multiple markets and multiple asset classes? And what's your edge? And I think so you have to answer, my edge is I have a small amount of capital, and even micro cap stocks will make a difference in my portfolio. Or I'm going to specialize in tiny banks and S&Ls because some are going broke and some are actually really cheap. So you could find ways to have an edge. There's no way you can do what we do. But I think there's, because of human nature, there'll always be lots of things to do. If you're indifferent about location, I think there's an argument that some parts of the world will lend themselves to greater mispricing. Those change also over time. If you were looking to do private deals, I think someplace like India or China or Brazil could be interesting, just because you might have the wind at your back more in terms of economic growth, maybe. That alone doesn't mean you make money, but it's a lot easier to think about how you make money with economic growth than you might in a stagnant Western European economy or somewhere like that. But I think no one person could hope to replicate a multi-strategy fund like ours and make sense of it. Yeah.
How do you manage against the risk of inflation, and do you worry about inflation in the US?
Yeah. We kind of worry about all kinds of risks. As Americans, we worry about the dollar collapsing. We are measured in dollars. Our investors are American. We hedge our assets back to the dollar. We're not top-down investors in currency movements. So I'd say we invest bottom up. We worry top-down. I think inflation is a serious risk. It's very hard for me to know the answer. I would have thought in some ways that inflation would be cropping up even as the economy is still relatively moribund, because government's printing so much money. I think that was just wrong for now. It's wrong for two reasons. One is it's lying about inflation, but forget that for a moment. I think that there's so much capacity in a lot of things will not have inflation. If they go down to the overall rate, even if food or oil or whatever is going up strongly. But I do think that also is kind of like a grease. There could be just a tipping point that one day nobody's worried about it, the next day everybody's worried about it. It starts factoring into decisions, it starts factoring into the CPI changes, and all of a sudden everybody's scared and people start selling on all kinds of health rate flus. When the government started printing money, and I guess soon we'll be dropping it from actual helicopters, but essentially dropping helicopters to the average citizen, we basically said, we can't figure out a good hedge on inflation, we don't trust tips, because the government gets to pay how much inflation there is, and the government always keeps changing the metric. They change it for 30 years. They keep defining it in different ways that always have it be lower than it actually is. And that's deeply disconcerting for all kinds of reasons, but nevertheless, I believe it to be the case. So you can't trust tips because they might never capture real inflation. In a sense, the bond market vigilantes will realize there's more inflation causing tips to actually not do well than many people think they will protect them from inflation. So rather we said, maybe interest rates will capture inflation. Maybe not day to day, but if inflation's bad enough, people will stop holding bonds with the fixed coupon. So we basically bought way out of the money interest rate puts, or the equivalent of puts, swaptions, caps. We've lost money so far. We traded a little bit. The dollars went way up, so we sold some, we bought some back. And I don't know if it's going to work or not, but if all hell breaks loose on the inflation front, we have a chance. Although, as you remember from your studies of Weimar Germany, that in some sense we will have shopping carts filled with dollars we make from our hedges, that'll be worth zero. So we're happy if inflation sort of 10 to 30 and start being worried if it's 100 or 1,000%. Hopefully the gap between today and that is a very big difference that will take a long time or will never happen. But in some sense, there's some rates of inflation you actually can't protect against. Yeah.
Can you talk about how you go about valuing a business? Like when you first got a 10K at a company you've never seen before?
We try to think about things in a variety of ways. One of the things that I'm a big believer, I guess I'd say two things. One is you can't precisely value anything. And it sort of goes to the margin of safety concept that, and it's one thing that makes Wall Street research reports particularly dumb, is they will inevitably say target price 48 or price 38, as if you could value a business to the penny. You know, I can't value my car within thousands of dollars. I mean, who knows? I mean, used cars trade all the time, yet they have a value that's kind of imprecise. I think businesses are the same. They're vast, they're highly complicated. And what does value even mean? Is value present value of cash flows? Is it what you can sell it for today? And it changes day by day. So it's hard to think that value can be pinpointed. So we believe in a range of value concept. And want to value a discount to kind of the worst point of that range, if not lower than that. But then we apply multiple metrics. I like to think also, if something is cheap on one metric, like that's almost like finding an excuse to buy it. Like, yeah, I know it's 5 times book, I know it's 25 times earnings, I know it's 15 times cash flow, but the dividend yields 4%. It's like, that doesn't feel very good to me, because if the dividend gets cut, or you focus on any other metric where you start to worry that the dividend might get cut, that's not going to fall in half. So I think having multiple metrics of cheapness, so if it's cheap on free cash flow, cheap on price to replacement cost, cheap on multiple metrics that might make sense, and those change business by business. So some businesses have stable cash flows easy to think about. A cyclical is much harder to think about. Replacement cost often is not relevant because you want to replace a Bethlehem steel mill. Nevertheless, I think that's the right approach, and so we will think about comparables, but we won't fully trust them, because why are they where they are? And we're not going to short them. They're moving. And if you have overvalued comparables, it's not really a big cushion on buying slightly less overvalued long. But we think about it pretty much every which way you could, with a particular emphasis on free cash flow, discounting that back. There's also no science in the discount rate that we're not running leverage betas and whatever to figure out discount rates. Rather, we fairly arbitrarily typically would use this. Often we run multiple numbers. So we would say, at a 10% discount rate. Here's the number at a 12, at an 8, here it is. And we similarly, we run sensitivities on the operations side. So we know that we haven't written down the right cash flows for the next 5 years. So we try to run a what if there's a downturn, and what if the business gets worse, what if competition intensifies. So we're running both positive and negative sensitivities. And also a lot of what we're doing isn't businesses. We're valuing residential real estate for mortgage securities, or we're valuing commercial real estate for those investments. We're valuing 2 businesses as part of one company with different metrics. The fast-growing part that you pay nothing for, or the spin-off that you're getting, may be valued at one metric, and the stable cash-flowing business may be valued at a more different metric. So I wish there was an easy answer. Broadly, I would tell you, I don't think anything we do is that hard. I don't think the analysis, other than the most obscure situations, is that hard. I think what's hard is the discipline, the patience, the focus on risk, and intensely working on things to not only to sort of prove out that your initial thinking was correct. Those things are, in some sense, harder and harder to have happen across many people at a complicated firm. Yeah.
Can you talk about your investors a little bit more, and specifically how you kind of go about the selection process and manage them, and what would you recommend to somebody who might be starting their own firm in terms of the approach?
So the analysts at our firm?
Sorry?
You're asking how we manage the analysts at our firm?
No, your investors.
The clients.
Yeah, exactly. And how would you kind of recommend to somebody who might be starting a firm things to think about in terms of investors?
I think when you're starting, you're on the desperate side, and you take whoever you can. Look, broadly speaking, because we were not trying to make a fortune in the first years of the company, we were trying to build a business. We basically went to people we knew, and we said, this may not be for you. Here's what we're doing. Here's what we're charging. And by the way, our fees were always and still are way below the average, let alone the high end of the industry. We're not looking to get rich off of anybody in the short run. We work really hard to put the clients first, and we communicate that and show it in our actions as much as we possibly can. And I've had one of our biggest clients say to me just the other day, he has this confidence that we will always do what's right for the clients, even if it's not good for us in the short term. And I was really proud that he would think that, presumably because I agree with him that he's right, but also because we have worked hard to do the right thing and have somebody notice. And unsophisticated clients won't notice that kind of thing necessarily, but the most sophisticated people in the world do and appreciate it. Broadly, what I would say to you is, I think it's not so much about who your clients are, although the more that they're long-term oriented, highly reliable people. Think about if you want a client who might sue you, a client who said, well, you were down 20%, and I think you told me you'd never be down. That staying away from litigious people, bad people. If your client is a bad person, if your client is a dictator in a horrible country, and you're making them money, you're betting something that's morally bad, and they probably will lie and cheat and not meet their commitments to you. So I think there are people to just stay away from. But mostly I think what the real message is how to treat your clients, whoever they are, with prioritizing their interests, open communication as much as possible, the highest level of integrity. You will have, by the way, anybody who goes into any business, especially the investment business, you will have conflicts of interest starting the first day. And how you handle those is a testament to your character. So to the extent that you can be clear when you have a conflict, everybody can identify moral issues very well, be clear when you have one, and be clear why you're doing what you're doing, because if you're doing it for you and not for them, that's probably the wrong thing. At our firm, we have 2 kind of ethical rules that we try to follow. One we call the Wall Street Journal test, which is basically how will your mother react reading about what you just did on the front page of the Wall Street Journal? And if you would be embarrassed to have her read about the CDO that you just created and shorted, that would be a bad thing, and you wouldn't want to do it. And then there's the football field test, which basically says if you run near the sidelines, you might step out of bounds, so run near the middle of the field. And those two tests actually drive us internally that you would be amazed how many, they sound ridiculous in some sense, how we take that into our investment process, but actually all day long, I mean, I'd say at least once a week, one of those comes into play where we say, how's that going to look? How are we going to feel? And I think it's fair, especially in the age of email and cameras and whatever, to assume that, and employee turnover, to assume that everything we do might be on the front page of the paper. So we better take a huge amount of care to make sure we're proud to read about it and not embarrassed to read about it. Yeah.
Many companies are talking about growth in the BRIC nations. Growth is all foreign driven right now. Do you actually buy the decoupling pieces? Do you have a view on whether growth can be really?
Yeah, the question's about the BRIC nations and growth and do we believe in it. I guess I would say that it, I would put a probability on it. I would say that it seems as the world is going that nations will develop, and that countries with the best infrastructure and an awareness of how that might be deployed and a capitalistic sense of values will probably do well. That doesn't automatically translate to stock market profits. And they're developing, not developed, so there presumably might be more political risk. The world could run out of resources, stymieing some countries as they're trying to develop, causing commodity prices to go through the roof or something. The world could have another economic crisis, and when Europe and America catch a cold, emerging markets might get pneumonia. So I'd say there's a probability, and at a price, those securities might be really attractive. That's not our game. We're just not going to be good at saying, I'd rather own this market at this multiple than that market at that multiple. There's probably lots of people that can do that well, but we just know our limits. And of course, knowing your limits is another important point in thinking about what your edge is. One of your edges, it's not really an edge, is not doing things you have no idea what you're doing. Yeah.
You mentioned that you look for a discount to the worst part of your valuation range, but are you looking for a minimum discount or a specific discount?
We probably used to, in our earliest days, think about discounts, and over time we've tried to think more clearly about returns. That if you buy something at a great discount, but the discount never closes, you may not be earning that much. So as part of our trying to also equilibrate between debt, where you can think easily about rates of return, and equities, where it's much harder, we don't want to fool ourselves. So we don't sit there and look at an equity and say, this stock trades here, and over 5 years it will trade in line with the comps, and therefore it'll be a 22 IRR. Because you have no idea, or at least that's one thesis, but there are many other theses, like it trades at a big discount still, or the discount gets worse, that you also have to think about. So we don't have a discount number. I would say also there's, in my mind, there is or should be kind of a relativity to what you do, not relative value. But if you're 100% cash and you find a decent bargain, that might be a great thing to buy. If you're 99% invested, your last dollar is probably pretty precious, and you might want to save it for better than a decent bargain. You want an extraordinary bargain. So I think as our degree of investedness changes, that might change. As our confidence in the situation changes, as the risk level of the situation changes, you might demand lower discounts or lower rates of return, albeit still good absolute returns. Our discount rate has changed over the last year somewhat. When we first went into the crisis, we thought buying safe kind of 12% returns was a pretty good thing to do. And then we were getting the same exact situation at 25 and 30% rates of return. I think to our credit, and part of this was probably a lot of years of experience, we knew that that was extraordinary and wouldn't continue forever. When the market started rallying after last March, we said, we don't have to get 25 or 30% to still have it be a good investment. And I don't think at all chased the market, but rather we never believed that the all-time low trade was where we had to buy the next purchase. So that kept us buying and keeping fairly decently invested, fairly fully invested, even as the market rallied a lot from last year to now. So there's no fixed number, but the absolute threshold, like I still don't want to buy anything if I don't think I'm going to earn kind of a safe 12. And then there's variability. So you can have a safe 12, but what's your worst case scenario? And if the worst case scenario is you lose all your money, that's very different than the worst case scenario being you have a positive 5. So if your worst case is positive 5, you might be happy to buy a 12. If your worst case is losing all your money, you might need a 30 or a 40 with a high probability of success to even possibly think about going along that.
Seth, why don't you take one more question?
I'll take one more question.
So you discussed in your letter a bit about how your first goal is to have a great process, and then hopefully there's a great return that follows that process. Can you talk about some of the attributes that you think are embedded in a great process?
Sure. So in my quarterly letter that I think we mailed today, I compared, if anybody's a big NBA fan, you should read something called The Book of Basketball by Bill Simmons. And Bill Simmons is a real character, writes on ESPN.com. And Bill Simmons wrote a 600, 700-page book about the history of the NBA.
What is that noise?
That's his cell phone.
Oh, you're close to that.
So Bill Simmons talked about the secret to professional basketball. So the secret to basketball has to do with being, I mean, it's amazing, because as I was reading it, I thought, this is exactly the same as investing. So who has the secret? Larry Bird has the secret. Michael Jordan, after his rookie year, has the secret. Kobe Bryant doesn't have the secret. The secret is teamwork. It's putting the team ahead of your own interests. It's not going for statistics, but going for results. So it's passing the ball. It's playing great defense. It's getting the ball to your open teammate, even if you think you can make the shot, you know that they have a 6-foot jumper and they'll likely make it. So it's a lot of things that are kind of intangible. In investing, the process is not dissimilar. There is no secret to it. It's just as there's no secret to basketball. It sort of calls it a secret tongue-in-cheek because it's so freaking obvious that most people don't do it. And I think that's the secret to investing too. So the secret to investing is a number of things. I think it's a value approach. It's thinking about stocks as fractional interest in businesses rather than pieces of paper that go up and down. I think it's a long-term orientation. Those are the two biggest parts of the secret. That's not a secret. The process part is incredibly important. As I mentioned in the letter, I read this from James Montier, who is now at GMO. Previously was kind of a sell-side strategist. And what he basically said is, around the time of the China Olympics, he interviewed a lot of athletes, or read interviews, I don't think he did. Read interviews with athletes, and they all were talking about how they prepared and trained and what they ate on the day of the event. And none of them talked about where they finished or their goal to win. Their goal is to do the best they could possibly do. And then the result was what the result was. And in investing, I think it's kind of the same thing, that if we do a good job of looking for opportunity and filling our inbox well, if we are highly disciplined, if we are patient, if we are team-oriented, if we let capital slush the best opportunities, if we don't forget to sell, if we put the clients first, if we hire great people, if we stay nervous and risk-averse and worry about everything that might go wrong, so hopefully it doesn't, we will do well. That will be a good process. If we get arrogant, if we think we can do no wrong, if we get impatient, if we let inexperienced analysts make overly important decisions, that if we let anybody have a short-term orientation instead of a long-term orientation, we will be screwing up. So process could be different at different firms. Broadly speaking, I think it speaks to the kind of characteristics and behavior that not only lead to investment success, but that make working fun, that make it a place that people like to be for a long time, that let you hold your head up during the worst of times. One part of our process that I'm most happy with is during the crisis, during the fall of 2008, because of the other parts holding together, we were never deer in the headlights. We were never frozen. We were business as usual every single day. I don't think there are that many firms that could say that. And not just business as usual, but we were buying stuff every single day. We were also selling where we didn't like something as much, where we thought fundamentals were wrong, we were wrong about it, or where it wasn't as cheap as something else. But mostly we were buying. And more importantly than that, the atmosphere was calm. The atmosphere was a analytical driven decision-making environment where, and also, by the way, right, how do you think about what happened before? How do you think about all the things that are killed that you might have screwed up on? You forget about it because none of that matters. The only thing that matters is what are assets that are management, what do we want the money in? But most people can't do that. So process put us in a place where we can take advantage of the crisis for the benefit of our clients and ultimately for our own benefit as well, in a way that without that process we would be lost. It's the same way that process in some sense is like a roadmap, the way value investing is a roadmap. If you're a momentum investor, what do you do when there's no momentum? If you're a growth investor, what do you do when growth stops? You're lost. Your map is kind of, well, I see that, but it's not what's happening, what I'm experiencing is not on the map. So your process is kind of a North Star just as value investing. Thank you so much.
Next.
Oh, yeah?
I wanted to get it. It's not actually so much that he made me do it.
Like I tried to do the hot.
She sold it, so her basis was basically I sold it. So sometimes oh no, I was patient. I was he was sort of slow getting back to the
So this is our it's something
so you're right. Divided up into two halves. So I work well what do I need? What do
you know, like I fix these things and then I play out and then you guys do some of the back and read. By the way, because you know.
I mean, you're always used to it was all the investment. No, it was beautiful. Like computer it was very what happens in
email, you never know. It could be like some 25-year-old guy.
Yes, exactly. The one he printed in
Yes, that's right.
They're always
We will. Some things I don't think I will put out. There are things I can remember versus trying to he does his research on what he's always using. You just say, what do I know? Oh, okay. That's right. What do I need?
Yes,
know the and there are very Goldman did something. Goldman is still much more. Oh no, now it's especially the city one. No, John Monfort.
And if one, trust me, if we give one person got it, then, we get 16 people to our office every hour. Gently speak to
we'll have
Okay, well, I was going to go.
Okay, cool. All right. Okay, I'm going to send you an email.
I'm sorry. Okay. Yes.
Your brother's smile. Oh, it's nice to see the original and you're like carbon copy, right?
Good luck. Yes. Share. I will be around at some point next week. Yeah, the best thing to do is email. And if I can handle it, I don't know. It's just, I found out it's going to be Saturday.
And so we'll have to keep on that.
No, it's reunions. Yeah. Okay, so at some point we'll.
Well, it sounds to me
So maybe when you would ask us, you know, okay, you can just come up with it.
Lisa. Okay. You gather your focus. Did you give the money to the urgent? You understand? You understand what we want.
That's his understanding too.
Right.
So he said, no, it's.
I know one.
There are two.
The point is always so that she's glad.
All right.
Yes.
And that way, I never have to.
I went down to that.
No, don't worry. Louisa, the only thing is this is Louisa, what you do is you need well, you respond. The only one is I have to.
Yeah.
It's not really.
They're not going to do it. You're right.
So I've lost the 2000.
What's our edge? I know, I'm with you.
All right, the thing is, that's the wrong question to ask.
What's our
What's
edge?
your age? Because everybody thinks they have an age, that's why they're in business. He's wrong about that. They don't think about it explicitly. Everybody thinks they have an age, so it's too easy to answer. Right, no, that's right. So the question is, why are you different from all the other people? And that's why it's so important. But the reason it's easier is, and it's the one thing it's so deeply ingrained in that he doesn't talk about, is the ground edge is worth just the
baseline.
ugly, obscure, overlooked.
Yeah.
Well, it's not watching pictures. That's what he likes to do. Yes. They're not on 6 8. Who's in on 6 8? Who's a real guy? Well, look, there are guys who say, there are all these corporate values that are the low, that track very closely the S&P. Those are not values. Value investors, if you ask them what they have a search strategy looking for what is disease. And disease is it. And most people don't have disease.
Because I suggest this consider. I think they're somewhat similar. And they were then also very successful. So if you can't get this,
I've known him since he was in USC. My wife was in his class.
Really?
Yeah.
What'd she do?
She's a media consultant. She just wrote personal notes. Got a lot of information.
Yeah, we're doing the value investing interviews right now.
Okay.
Yeah,
So I
I
look
know.
forward to seeing you.
Yeah, no, we've got somebody behind us, and I'm.
Oh, that would be
super
wonderful.
Yeah, when is she going to be here?
Oh, okay.
All right, so you email me that. All right, and give me a little background.
Oh, yeah.
All right, thanks.
My mom.
Yeah, exactly. All right.
Oh, good. Thank you,
Okay. All right. See you. All right. So shoot me another.
I will.
Please.
Thanks.
Ms. Wallace.
All right, guys. I'm going home. See you guys out here.
Aaron, I think we've got two incredible ideas.
Yeah.
But
Did you guys meet? No. Jenny? Oh, we did. This is Lisa. This is Jenny Wallace. She's on the board. She's in the lawn. You're in the lawn.
Oh,
Yeah. All right. So, yeah, no, I thought that was good. I'll follow up with you. Are you
Are you kidding? She's in bed.
I wasn't.
No, she's in bed. She's always in bed at this time. Are you kidding? What time does she wake up? Oh, she's not asleep? Oh.